So welcome everyone to another monthly webinar series with Carl and I. Today we are going to be talking about the missed tax opportunities of 2021 and what you can do to not miss out. So just a brief synopsis of what he will be sharing is that now that the 2021 tax year is behind us, it left many missing out on important tax saving strategies that could have made a big difference. But now that many have budgeted for 2022, there are still many tax saving strategies that you can still use.
So what I wanted to do is go through and focus on some more simple tax things that most of us maybe are already doing, but maybe there's some strategies that are within reach of more or less all of us that we should be doing. And then we'll go a little bit more complex until at the end. What I want to do is I want to touch on something that's topical right now, and it's probably on everybody's mind to some extent. And that's the fact that Elon Musk has recently bought Twitter, and he's currently in the process of financing his buyout of Twitter. And some of the tax strategies that we talk about, he is actually employing right now in that purchase. So I'd like to touch on his filing and how he's using some of these strategies in the filing to buy Twitter. So here are you, and you're running your business. And there's a lot of different things you could be doing. You're going to be selling something. So you're selling something and you're getting some kind of income for selling it. Running your own sole proprietorship, 100% of that income is going to be taxed. So number one, what we want to do when we're setting up a business, as soon as we have some kind of reasonable income coming into that business, we want to incorporate. So that business is no longer going to be the sole proprietorship. Now that is going to be a corporation. And there are two reasons you want to do that. Reason number one is we get the small business deduction. And reason number two is that we can start to defer tax. So to defer tax means to pay the tax in the future rather than paying it right now. And the reason that we want to defer tax is if we defer tax, that gives us enough time to put in other strategies where we can eliminate that tax. So it's always defer is step number one. We just don't want to pay that tax right now, just to give us enough time to figure out how we can eliminate it completely. So number one, we want to incorporate. That will be our first simple strategy to reducing tax. Number two is we probably want a principal residence. So this may not sound like a strategy specifically for a business owner. It's actually probably something most Canadians should do, is get a principal residence. But there are a few reasons for doing so. Reason number one is that it is going to grow tax-free. When we get to about $14,000, that's when we start paying tax, and we start paying it at the 15% rate. Okay, so that's an important number. Paying at the 15% rate is when we go over here and we look at the tax rates for a corporation. We can see that the tax rates for a corporation within British Columbia are 11% for a small business. So we can see that 11% is less than 15%. So as soon as we start making any significant money within our business, it starts to make sense to incorporate. So of course, you see the first tax bracket is only 0. So we don't care about 0. So if you're making less than, say, $15,000, there's absolutely no reason to incorporate. But once you start making more money, potentially up around $50,000, you're going to want to consider incorporating because your tax rate is up at 28%, right? So anytime after this kind of 20,000 mark, it makes some sense to incorporate, but it just starts to make more and more and more sense the higher we go up the tax tables. Until we get to $227,000, the bottom one, you'll notice at that point, we are paying 53.5% tax. So if we compare 53.5% tax to the 11% tax that we're paying as a corporation, it really makes no sense for us not to be incorporated at that point, right? So just so you understand where that applies, that is for a small business. So that is up to $500,000. If you're making up to $500,000, you'll only pay that 11% tax. After that, it'll be the 27%.
Hey, Carl, I often get that question like I make $70,000 or I make $100,000. What number should I incorporate at?
Yeah, so it is important question, what number should I incorporate at? But that's one of two questions. So number one is, what's the number? Question number two that you need to answer for yourself is, are you spending all of your money or are you saving some money every year? Because if you are saving money every year, you're probably going to want to start saving that money in the corporation. So there isn't a real number, but the number is, generally speaking, above $20,000. So there's some justification to do it anywhere above $20,000. And the reason just becomes more and more compelling as we go higher up the tax table.
So I guess if people wanted to know, like for their specific situation, what number they should incorporate at, they should give you a call, right?
Yeah, they could give me a call. They could potentially talk to their current accountant also, but I'm happy to talk to them about their number. Cool. So that is number one. Number two, the principal residence. So these may not be new ideas to you guys, but I just want to emphasize the importance, even for a business owner, of something like a principal residence. And again, we'll see how that comes into play a little further on. So number three, again, if you are in that lower income bracket, you're only pulling out a little bit of money, you want to put the money into a TFSA, and you generally want to max it out. So again, if we look at our tax tables, we want to make sure that we're only putting the money into the TFSA if we're only making a little bit of money. So that might, a line in the sand might be $50,000. If you're making $50,000 or less, then you're only paying 22.7% tax. So anything under that, that's really TFSA territory. So you can pull the money out of the corporation and put it into your TFSA. So that is if you are currently low personal income. If you are high personal income, you're going to want to look at putting it into an RSP. So when we're considering what is exactly high personal income, we want to go back to the tax rates again. And we want to consider, okay, if I'm going to pull this money out as an RSP, I probably want it to be higher than the high corporate tax rate. So if anybody's getting confused by this, please put your hand up. So we look at that 27% rate that we would be getting in the corporation, and we use that just as a little bit of a litmus test to see where we should start pulling our money out and putting it into an RSP. So I would suggest it's anywhere above $86,000, because we can see that that's a 28% marginal tax rate. So if you're making more than $86,000, you probably want to start pulling some of that money out in RSP. So that's number four. number 5, so these are the more simple solutions that you probably want to be putting in place as a foundation for yourself. So number 5, so this is when we start pulling some of this money out and using it personally, right? We've got our corporation, number 1, we got it in place. We're starting to pull money out and using it personally. We're going to put that money into a principal residence. We're going to put it into a TFSA. We're going to put it into an RSP. Now we can start looking at corporate investments. And when we're looking at corporate investments, we want to look at insurance as a corporate investment. So the reason for using insurance as a corporate investment is it acts as a TFSA because it is going to grow tax deferred. We're not going to have to pay any of the tax as this grows within the corporation. So just as, and we don't have this opportunity within the corporation, that's the first place we're going to go as an individual, but we do essentially have this opportunity within the corporation. So once we've taken care of ourselves personally, then we can start to make sure that within the corporation, we're taking advantage of similar tax structures. So insurance is the only way to put a TFSA into your corporation. It's not actually a TFSA, but it operates very similarly. And then number 6, we want to make sure that those investments within our corporation are capital gains. We don't want rent where we could help it. We don't want interest because those things are going to be taxed at a very high rate. The tax rate within our corporation on any passive income is about 50%. So rent is going to be taxed right from the first dollar at 50%, and interest is also going to be taxed at 50%. Capital gains, the tax treatment is like this. So within our corporation, say we have a gain of $100,000, $50,000 is going to be exempt from tax. So that's no tax. And then $50,000 is going to be taxed, and it's going to be taxed at the 50% rate. So we end up with having to pay $25,000 of tax. If it was rent or interest, it would have been $50,000 in tax because these are 100% taxable at the 50% tax rate. So that's step number 1. We pay half the tax that we would as we would in these investments. But here is the best part. Number 2, that $50,000 that's not taxable, that is going to come out of the corporation tax-free. So we managed to pull $50,000 out of our corporation without paying the tax on it. So usually it would have to come out as salary or a dividend, and it would be fully taxable. But this capital dividend that we get from a capital gain will not be taxable when we pull it out of the corporation. So these are all the more simple solutions that we're going to want to put in place, generally speaking. And of course, I'm not giving you specific tax advice right now. I'm just talking generally about what you would want to do. But these are, 6 simple solutions that you would put in place just as a foundation for your tax planning as a small business owner. So from here, we would go into things that are a little bit more complex.
Number 5 was insurance corporate investment.
Yes.
And what was that? You have to, can you summarize that one again?
So with our insurance as a corporate investment, essentially the way the insurance works within the corporation is the same way a TFSA works. So we are going to have the opportunity with this insurance to put it in the corporation. So we have the insurance inside the corporation, and it is going to grow. And as long as we don't take the money out, it's going to grow tax-free.
Okay.
just as a TFSA would in our own personal
I
hands.
see. I see. And then number 6 was capital gains. What did you say about capital gains?
So the great thing about capital gains is that it has a preferred tax treatment. And there are 2 parts to this preferred tax treatment, and maybe I'll write them down as separate parts.
Okay.
Number 1 is that we get a capital gains exemption.
Okay.
So that means that 50% of our gain is not taxed.
Yep.
So number 2 is that when we actually sell, as whenever we realize the capital gain, this 50% that is exempted from tax creates a capital dividend. And that capital dividend is essentially a tax-free dividend to whoever owns the corporation. So these 2 go together to make capital gains an attractive investment within the corporation. So
Like
if you
mean
are
capital
going,
gains buying a property on using capital gains.
property produces capital gains, yes.
Okay. So
So
you're
property
buying
would
a
be a good
property
one.
under your corporation.
Generally speaking, it can make sense to have property under your corporation, and it can be good for that specific reason when you're getting the capital gains.
Okay, when we sell 50% of our gain is not tax, creates a tax-free dividend.
Exactly. So we'll move on to the second part, and now you'll start to see how these different areas make some sense, the foundation that we put in place. What we're doing is we're starting to put these things together a little bit. So here's your corporation. So you've incorporated, that was step number 1. You also bought a principal residence, and you probably bought that principal residence with a mortgage. So we love the fact with our principal residence that we are living rent-free, and we also love the fact that we're getting growth tax-free, right? So those are some very good things about this principal residence. We maybe don't like the mortgage so much because the interest is what we might call bad debt or bad interest because it's not deductible. We have to use after-tax dollars for this interest, right? So what we do, or what we have done, because we got this in place a few years ago, we have our insurance inside the corporation. So that insurance has grown over the years and it's grown tax-free. So the nice thing about the insurance, again, is that it grew tax-free. It's a very stable asset within our corporation. So now we've built up a bunch of capital within the insurance. We've got this mortgage outside the corporation and we've got this insurance inside the corporation. So what we can do is we can borrow against the insurance and we can pass that borrowing out and we can pay off this mortgage. And essentially what we're doing is we're transferring the debt from us personally to our corporation. So why would we want to transfer this debt that we've got personally into our corporation? So essentially, the reason we want to do that is that when we have debt within a corporation, now the interest, because it's interest used for a business purpose, is going to be deductible. So now we're starting to combine different tax advantages together. Now we have this house, which we're living in rent-free, we're having that tax-free growth, we're getting all of that personally. Our problem was that this interest was not tax deductible. Now what we've done is we've converted that interest into corporate debt. So now that interest is tax deductible within the corporation. So when we look at this scenario, we've managed to really get the best of both worlds. Really, the CRA does not want this interest to be tax deductible, because we're using it for a principal residence, which it grows tax-free. But we've managed to have a tax-free growth plus deductibility. So that's how we can start to combine some of these things so that they become a lot more powerful. So this is number one of the more complex ideas. So if we take this principle and we take it to its logical conclusion, we start to see that we've got a big advantage of having some kind of assets within our corporation that we can leverage out and use personally. Or we can leverage these assets out and use them for business purposes. So that leads us to number two, which is a little bit related to number one, but different enough that I think it deserves its own discussion. So in number two, now we've got assets. And I would argue that insurance is one of the more important assets. But you might have things like stocks, you might have things like real estate. So what we want to have is a pool of assets within the corporation that we're not necessarily selling, we're not necessarily pulling all the money out at any one point. But what we're doing is we're borrowing against those assets. So we may borrow corporately, and then we might buy a business, or we might borrow personally from the corporate assets. And at that point, we might buy investments, or we might buy a home. There's a number of different things that we could use that money for once we borrowed it out of the company. We could either even borrow from those corporate assets, and we could use it as our living expenses. So we know that every time we pull money out of the corporation personally, we're going to have to pay salary, we're going to have to pay tax on that salary, or we're going to have to pay tax on the dividends. When we borrow the money personally from the corporate assets, we don't have to pay salary or dividends tax. So that is a strategy that a lot of wealthy people use. And it was quite popular in the media a little while ago in the US. It's called buy, borrow, and die. And the whole idea is you're going to buy assets within your corporation. So buy assets, and then we're going to borrow against those assets from the bank. So we're going to get a loan. And then we're going to die. When we die, whatever proceeds we have from our death goes to pay off that loan. So during our lifetime, if we structured it 100% correctly and we had this kind of opportunity, we could go through our whole lifetime without paying any tax. We just bought these assets. We never sold them, so we never realized any gains. We borrowed against them personally for our living expenses. Maybe we got some assets. And we borrowed against them in a business perspective to grow the business in different ways. And then we died. Maybe we got life insurance that pays out any loans that we had. Or maybe the assets are sold on our death and it pays out any loans that we had. So that's how we go through our whole life and not pay any tax. And that's one thing that people like Elizabeth Warren was really upset about recently with a lot of billionaires in the US, is they've got access to these kind of strategies to not pay any tax. Fortunately, because we are business owners, we have access to these kind of strategies too. We can implement something like this for ourselves. It's not always 100% that we'll never pay any tax. And in fact, it often is not that way, but we can reduce our tax bill significantly over our lifetime in at least partially using a strategy like this. So that one was a little complex. I don't know whether anybody has any specific questions about how that works.
Can you reiterate the part where you said about you don't have to pay salary or something like that?
Yeah, so there's two different scenarios here. Scenario number one, we're going to borrow corporately. And then we're going to use it for some kind of business purpose. We're going to maybe buy some real estate, maybe buy another company, maybe just invest in our own business because we're hiring people, or we could bring in more inventory, anything, right?
Mm-hmm.
And then number two, we can borrow personally. So we're going to borrow personally against these corporate assets. So even though the corporation has all this insurance, that's probably the most effective one that I know. The corporation has all this insurance in it, and maybe that insurance now is worth $2 million. So I decide, hey, I would like to borrow against that insurance personally, and maybe borrow $200,000 out a year and fund my lifestyle against that $2 million of value that I've got in the corporation. And because I'm just borrowing the money, I'm not taking it out of the corporation, I'm just borrowing from the bank that money. It means I don't take it out as a salary, I don't take it out as a dividend, I'm just borrowing against assets. So there's no income tax to pay.
Oh, so there's no income tax to pay, and it's also tax deductible.
It's tax deductible if you use it for investments.
Okay.
If you use it for living expenses, it's not going to be tax deductible because you need to use borrowed money for a business purpose in order for the interest to be tax deductible.
Okay, but so if you used it to pay your employees' salaries, that's
deductible.
Okay.
Yep. Even your salary, if you decide to borrow and then pay yourself a salary with that money, then that would be deductible now within the corporation.
And if you pay for living expenses, there's no income tax.
Yeah, you end up with no income tax that you're paying because you're just borrowing against this money within the corporation.
Okay.
I have a question.
Yes.
When you borrow from the corporation, right? Even though you own, even though you're a shareholder there, but don't you have to pay the corporation interest on the borrowing?
Yes, you do. So you have to pay interest to the corporation. You also have to pay a guarantor fee. Guarantor.
Yeah, I'm actually, can I backtrack a little bit?
Yes.
When you talked about your a mortgage, right? A mortgage.
Yes.
And to borrow money from your corporation to pay the mortgage, are you talking about, I need to put some numbers so that I can understand that. Let's say the mortgage is 200,000 on your personal house, okay, your principal residence. So are you saying to borrow the full amount for corporation, 200,000 to pay off your mortgage?
So there are two different scenarios that would apply. I don't know specifically kind of the details of either your or the example you're giving the case there, but there's two different ways to do it. Number one, we borrow within the corporation and then we pay out salary. And we use that salary to pay down the mortgage. And that brings the debt into the corporation. So there is tax to pay on that salary that we pull out. But depending on our marginal tax rate, say our marginal tax rate was, say we were pulling out enough money, say it was $100,000, up to $100,000. We were living on $40,000 of that, or probably more, but say we're living on $60,000. So the difference of 40,000 can go to the mortgage, and we're only paying a 30% tax rate, 32%, right? If we were pulling out more like $227,000 a year, then it may not make as much sense to do that because we're paying so much money to pull the money out, right? We're paying the 53.5% rate to pull the money out. So salary would be one option for pulling that out. The other option, if it made sense from our tax, our marginal tax rate, would be to borrow it personally and use that for the mortgage to pay it off. But generally speaking, this first option is the one that we're employing.
Yeah, and you did mention that, then you kind of switch the mortgage, like you borrow to pay, borrow from corporate to pay your principal residence, that you're actually transferring the mortgage into corporation.
Yeah, essentially
So
that's what it is. Yeah, that's the idea. You're trying to bring your mortgage into the corporation. That's exactly what you're trying to do.
What about the home title now? It goes to corporation?
No, the home title remains with the individual. We want to make sure that it remains with the individual because we want to make sure that it's a principal residence and we're getting that tax-free growth, right? One thing I want to clear up, I think it might be helpful to state this. We're not actually transferring the mortgage into the corporation, so there's no legal transfer of the mortgage into the corporation. But what we're doing is we're paying down the mortgage with corporate debt. And in paying down that mortgage, essentially what we're doing is transferring that debt back into the corporation.
Okay, it's like transferring the mortgage, so it's not legally transferring the home title. Okay, all right, thank you.
From a strategic point of view, we're transferring it. From a legal point of view, we're not transferring it.
Okay, thank you.
So you get a mortgage, and then you get a mortgage on your principal residence, but because you've purchased an insurance policy in your corporation, you borrow from that insurance policy, let's say $100,000, and then you use the $100,000 to pay your mortgage payment. And then therefore, when you use borrowed money to pay your mortgage, that's tax deductible.
Within the corporation, yes.
Within the corporation.
Yep.
And so you're not using your personal income that's after tax dollars to pay the mortgage. You're using borrowed money from the insurance policy to pay your mortgage.
With the caveat that you do have to take that money as salary. So it will be taxed on the way out, but you get an offsetting deduction within the corporation from the interest that you're paying.
I see.
So then when you pay back your corporation, you pay back, say, a monthly installment you have to pay back to the corporation, or no? You still have to repay, right? Because there's a separate entity altogether, the company and yourself. So you borrow 200,000 or 100,000 to pay off your mortgage. Then, like you will pay back your corporation whatever arrangement, quarterly or monthly, right?
So there's no time period where you have to pay back your corporation. You could pay back your corporation at death using the proceeds of the corporation. Maybe you have insurance in here, and maybe use the insurance proceeds to pay out any final debt from the individual.
So Selena is asking, like, don't you have to pay back your corporation within 1 year, or it's going to be considered as income?
Oh, so we are not borrowing from our corporation. We are borrowing against corporate assets. So that's the distinction. If you borrow from your corporation, yes, you have to pay that money back. But what we're doing is we're just going to the bank and we're saying, hey, I want to borrow $500,000. And the bank says, okay, yeah, we'll lend you $500,000. What do you have for collateral? Oh, well, I have this insurance policy in my corporation. I have some stocks in my corporation, some cash. Are you okay with that? Yeah, we'll lend you the $500,000. based on these corporate assets, but the corporation actually isn't giving us any cash directly as a loan.
Oh, I see. But I thought that when a bank borrows money, whether to the corporation or to a corporation, when you borrow money, the bank would usually ask for the purpose of it, like if it is for investment. I know CRA will let you deduct your loan interest or mortgage interest against your corporate income. All right. But if you are borrowing the money to pay for a personal principal residence, I don't think the interest, the loan interest is deductible because it's not producing income.
Exactly. So in scenario number one, where you're borrowing that money and the purpose of that money is salary, then salary is a valid business expense and you will get the interest deductibility.
Okay.
Scenario number two, where you're borrowing personally, you do not get the deductibility. You're exactly right.
Yes. But who would borrow like 200,000 all at one go to pay salaries? You mean the corporation could borrow 200,000 right away this instant and then pay salary, use it to pay salary over years? That's acceptable?
Yeah, you would probably want to pay it over a couple of years just because you don't want to get into the higher marginal tax rates, right? But yeah, it's acceptable.
So then when you do your taxes and you do the deduction, then you have to be, the interest you have to apportion such that, like you will pay salary like 80,000 a year to some staff, then you have to calculate the interest proportionately up to 80,000, the interest that is incurred from 80,000 as the yearly deduction. Then you have to do deduction over a number of years, right? Until you run down all the application of the 200,000, right?
Exactly. But what you would likely do, say you were in that situation. So I'm going to draw a new one because it's just getting kind of messy here. So here we are. Say we've got insurance. That's the one that I would kind of recommend. So we've got insurance within the corporation that's worth $2 million.
Yeah.
And say you have this mortgage you wanted to pay out. And you borrowed the $2 million, right?
Yeah.
So probably what I would want to do is whatever the amount, say it's $100,000 in salary, pay that out against the mortgage. So that's tax deductible because it was salary to an individual. And then I would probably want to take whatever it is, 600,000, which is business expenses, and pay all my business expenses with that.
Okay.
And then I've got $1.3 million left, right?
Yeah.
Then maybe I want to invest all of the rest of that money. So now that full $2 million, that's all tax deductible because I used it for this salary, which is a tax deductible expense. Yeah. Business expenses were all tax deductible, and using it as carrying for the investments was also tax deductible.
Yeah, I mean, like on theory, this one looks like it's workable, but who would, as a banker, why would I want to lend you $2 million to pay all your expenses? Because then the business is supposed to produce income. Supposed to produce income to pay your expenses, right? So
yeah, well, the
if
business,
you have income that,
so that income, so the business will have income, correct? That income, now we can decide what to do with that income. Maybe that income goes to investments. Maybe that income goes to fund more insurance. There are a number of different things that I can now use that income for to cycle it through. So I'm using debt for most of my expenses.
Yeah, I'm just playing the advocate of the devil, right? If I were the if I were the banker, I would be asking this question: you're borrowing $2 million. I'll be looking at your business and how much you are making, like your income against your expenses. But if your income is enough to cover all your expenses and you still make a profit, why would you need to borrow money to pay for your business expenses? I mean, you borrow money to pay for investment, yes, but to pay for expenses, I don't know. I'm just playing the advocate of the devil here.
Oh, you're borrowing money primarily just because it's deductible. So if you're a more conservative person, you probably don't want to borrow this $2 million right off the bat. Probably what you want to do is you want to borrow only a portion. Maybe you've got $2 million that you could go to, but maybe you want to borrow 500,000 right now and use that only for the salary and a little bit for investments.
Yeah,
and then use
I get
income to
it.
cover the expenses.
Yeah,
right?
I get the tax strategy here. I'm just thinking like whether it's so easy to secure borrowing from a bank for these purposes. I mean, I understand the tax strategy there, but how practical is it to go to a banker to borrow that amount of money?
Actually, generally speaking, with the bankers, the more you borrow, the easier it is to borrow. If I go in and say, hey, I want to borrow $50,000. Well, actually $50,000. Yeah, my computer just crashed.
Oh, okay.
Yeah.
I don't know what happened.
Yeah, I think I get it now, because so long as the collateral is enough, I think the banker probably won't care so much, because if you have investment at 2 million for them as a collateral, I don't think they probably, in a business, I don't think they probably need to know what you use it for, so long as you default, they have a 2 million as a collateral. Am I right?
Exactly. Yeah, because
okay, got it. Yeah. So the other part, from the banker's point of view, so long as I have in hand a collateral of 2 million, I'm fine. I can lend to you 1.5 million, whatever it is. And the other part is how you deal with CRA is another thing. Okay. I think I got it.
exactly.
Thank you.
So yeah, sorry, my computer just crashed, so I'm just on my iPad now. I'm booting back my computer back.
Yeah,
So-
this is like really like advanced strategies that,
Yeah, it's a bit of an advanced strategy. I apologize. It is a little
but it's really good. It's really useful. Like, I didn't learn this growing up. MBA didn't.
no, no, not many people did.
Yeah, not many people understand this strategy, and not many people like use it. But the ultra high net
No, there's very, very few people that use a strategy like this.
But I'm guessing with your work with the ultra high net worth, they use this strategy all the time.
Yeah, well, I actually have certain clients who are very, very purist with this strategy. So these clients refuse to take any taxable income. The only income that they will take is whatever they can borrow from their corporation.
Really?
So they refuse to take any income whatsoever.
Wow.
I actually have one more question, but I'll probably wait to the end. I don't want to take
Oh,
so much
we're
time now.
actually at the end, Anne. So feel free to ask.
Oh, yeah. Like insurance product, right? Of course, my knowledge of, I'm a layman's knowledge of insurance products, either life insurance or endowment insurance. But a corporate buying insurance, is there such insurance policy as just strictly investment insurance, investment, you know what I'm saying, policy? It's usually life, right? Life or term. Oh, can someone hear me? Oopsie.
Anne, I heard you. I think Carl's just booting up.
Okay.
Carl, did you hear Anne's question?
Oh yeah, she was saying that it must be some kind of investment insurance, which is exactly right. It is an investment insurance that we're looking at.
Yeah, I've never heard of investment insurance. I've only heard of life insurance, term insurance, endowment insurance, savings insurance. That's it.
Yeah, so essentially we're taking an insurance policy And we're jacking it up with as much cash value as possible to make it look like an investment.
Yeah.
So
And sounds like you should
essentially,
give
it's like
Carl
a
a call.
term insurance. Then it's like a term or life insurance. Is that right?
It's a whole life plan.
Whole life plan, but who is the beneficiary? The corporation. It's a corporation, right?
Yeah, the corporation is the beneficiary. That's correct.
The corporation is a beneficiary. Oh, okay. Okay, got it. Thank you. Sorry, I'm
Those
just
are good
asking too many
questions,
questions.
man.
I
No,
should
no, no,
let
no,
other
no. Dan, that's
participants
great.
ask.
Yeah, those were good questions. So
Those are good questions.
I think we only
Thank
have
you.
a few minutes left. Do you want to look at what Elon Musk did?
Yeah, I'm interested.
Okay, we'll move on to that. So I went online and I got the filing that Elon Musk did. So he has to report how he's going to buy Twitter. So it's a 13D, and if anybody wants to look it up themselves, they just go online and you can see right here. I don't know whether that's big enough for you. So it's a 13D filing that he had to do to show everybody how he was going to do this, because it's a public company. So he has to do it publicly. So essentially, if we look here, he used a margin loan facility. And that margin loan facility was on his Tesla shares. So there we go.
Can you explain in layman terms?
Sorry, yeah, so essentially what he did is he borrowed all the money against his Tesla shares. So he was able to borrow 20%. So he had, say he had 100 billion of Tesla shares, that means that he can borrow 20 billion for whatever he wants. In this sense, in this case, it's this purchase, right? So that's how the billionaires make these kind of purchases. He doesn't want to sell out his Tesla shares for two reasons. Number one is he really believes in Tesla and that they're going to increase in value over time. Number two is, why would he, if he sold out $20 billion of Tesla shares, he potentially would have to pay $10 billion in tax on that. And maybe Elon Musk is fine with that. Maybe he's okay with paying $10 billion tax because he wants to support the country. But he couldn't make this deal work because now he's only got 50% of the money he needs to be able to make the purchase, right? So essentially, what we do is we borrow the money out so we don't have to pay all this tax, and we can move ahead and do the kind of deals that we need to make. Pull the 20% out and buy all the Twitter.
And so
we're going to go into a little more detail in this next time, but I just wanted to show you essentially how he's doing this and how it's in line with what we were talking about before. The whole idea is that what we want to do is buy. So Elon Musk, of course, bought Tesla shares. Then we want to borrow. So he's using this loan to borrow the money to invest in Twitter. And then eventually he's going to die and his estate will pay out these loans, right?
are you drawing on your screen? We still see the schedule, the 13.
Sorry?
Were you drawing on your screen? I'm still looking at the schedule 13D.
Oh yeah, I was drawing on my screen. Can you see it?
No,
Oh, okay.
I still just see the schedule 13D.
Oh, so I guess maybe my screen has frozen.
Oh, wait, hold on. Okay, this should be, I made you a co-host so you can share your screen again.
Okay.
This is brilliant. This is how the wealthy do it. They borrow against whatever huge asset they have. And usually that's within a corporation.
Yeah, and you don't get any more wealthy than Elon Musk.
Yeah.
Is the wealthiest man in the world, right? So
Yeah.
And it's not that we're guessing that Elon Musk must do this. He is forced legally to file the way he makes these deals. And we can see specifically, this is how he's doing it, right? So that is how the wealthy put together these kind of deals. That's how the wealthy, generally speaking, they support their lifestyle. Again, I don't want to pick on Elon Musk too much, but last year there were a lot of politicians complaining that Elon Musk wasn't paying enough in tax. And so Elon Musk purposefully pulled out, I think it was $11 billion out of his corporation, just to get that tax hit. But basically, that's just kind of the exception to the rule. It kind of proves the rule. We know that he never pays tax outside of that. He felt like he should pay some tax. So he did it the way we would usually do it, that we would just pull out that money every year and pay the tax on it. He decided in that 1 year, hey, I should pay some tax. It's not fair. I'll pull all this money out, and he did it. So just that he did it that 1 year when he was asked to pay some tax, essentially, shows us that generally speaking, that's not the way that he would operate. And I'm not trying to pick on Elon Musk. I believe he has the right to use the best strategy for himself. I believe he's really helped out, for example, the transition to sustainable energy. I think he's doing a lot of good things, but from a tax perspective, he wouldn't generally pay as much tax as somebody who's earning a lot less money, because he's got the opportunity to put this kind of strategy in place.
Wow. Okay. Any other questions? Anybody else have any questions before we close off this webinar and look forward to the next one? Any other questions? Okay. And of course, like Carl is open to have yeah. And were you about to say something?
Yeah. Sorry. This is recorded, right? So
yes.
Like, will we be able to look it over again? How do we get to look at this webinar again? Because it's overwhelming, certain things, right?
Yeah, this is recorded. You just need to message me, Carl, or Hassan, and then we will send you a copy of the recording. And of course, Carl is open for consultations. He doesn't charge for like a phone call. So feel free to reach out to Carl and just explain your specific situation, and he can definitely just have a consultation with you. Hassan just posted his email on the chat. So you just send him an email, and Hassan, once we get the recording, we'll send you a copy of the recording.
And we also post these to YouTube as well. Gary,
yeah,
right?
we post these to YouTube once they're edited. Yep.
Okay, thank you.
Sorry, go ahead.
I just want to say thank you.
Oh, you're welcome. So one thing that I just want to make clear, I think I may have said it right from the beginning. This is all very general financial information that I'm providing with you. It's not necessarily going to work for any individual out there. If you want to put something like this in place, you probably want to talk to somebody like me about your specific situation or your own tax professionals so that you can figure out whether these strategies work for you.
Yeah, definitely. Definitely. Any other questions or comments? Okay, well, thank you, Carl. I'm looking forward to our next topic next month. I think, Carl, you will let us know what we're going to be talking about next month.
Yeah, I think we're going to focus a little bit more on this strategy and
Nice.
how rich people actually use it, different rich people, and maybe a bit more focus on Elon Musk and how he's
Nice.
managed to use this strategy in his life.
That's great.
And
That's great.
Gary and Carl, one last thing I wanted to share was like with everyone, the dates for our future webinars, you know, just so you can lock it into your calendars and just so you know in advance for our next webinars pretty much. So if you have a pen and paper, I'll quickly tell you all about, you know, the dates. And then obviously a week before each webinar, you know, you'll get a reminder email. So for the next webinar, our next one is going to be May 25th. That's for May. For June, they're going to be June 22nd. And then for July, it's going to be July the 20th. And they're all going to be at the same time, 5 p.m. PST. So those will be the dates for the next webinars for the next 3 months.